Hi everyone, this is Mike Kramer, Mock Capital. Today is Wednesday, November 6th, and it's around 6 a.m. New York time. So obviously last night we had the elections here in the U.S. It appears that Donald Trump has won the election. We're also waiting to find out, the balance of the rest of Congress, meaning, who takes the Senate. It looks like the Republicans are taking the Senate, and it's still open as to who's going to claim the House. So you're seeing big shifts in everything, really, given these outcomes so far. So the most important thing that we want to make note of is that you're seeing the VIX index, which is the volatility index, dropping from where it closed last night at around 20.5, trading down around 15.5 to 16 this morning. And that's a very important thing because this volatility reset is allowing and helping to drive the S&P 500 higher as event risk premium passes, right? And of course, we still have the Fed meeting on Thursday, which is another important event. And so I think this is one of the most important things to keep an eye on during the day. The other thing, we saw the VIX 1D move up dramatically yesterday going into this event. This is also going to come down sharply as the event risk passes of the event of the election. And you can see that the S&P 500 futures we're going to look at this morning are trading up by about 2% right now. And when we just look at it from a technical perspective, you can clearly see here's your uptrend, part of the rising wedge pattern that broke. And to this point, we're trading just about back to that level at around 59.39. And so again, this is an important area we're going to want to watch, because if we kind of look at it from just a Bollinger Band standpoint here, you can see the upper bands around 59.60, and that's going to be something that you're going to watch for resistance, as well as this region in here. Obviously, as the day goes on and the news settles out, there's a chance here that you could start seeing some of these gains given back, especially given the fact that, if you take a look at interest rates, those are up significantly today here in the U.S., up over 4.45. The 10-year, again, we don't typically focus on rates, but the 10-year is at the point where it appears that it could be breaking out of a falling wedge, and that could mean that rates have much further to go to the upside. And if there's going to be one thing that potentially derails the equity market here in the U.S., it's going to potentially be rising rates. So this is something to keep an eye on, right, in this region, because if you notice, the Nasdaq futures aren't up quite as much, up about 1.7%. They haven't taken out their highs yet compared to where the S&P is, for example. You can see we're still below the highs that we saw at the end of October. So this is an important divergence that you're not currently seeing, that you want to pay attention to, because it could be the case that the market doesn't like the idea that rates are rising so dramatically. They can tend to impact growth stocks. And so when you look, you can see right now we're trading back to resistance around 20,680. This is obviously an important spot to watch. So again, if you can manage to get above 20,680, you're talking about maybe moving up to 20,910 on the Nasdaq futures. When you look at the E-minis on the Dow, those are up almost 3% on the day, clearly taking out their prior high. Again, upper Bollinger Band somewhere around 43,850, so that's a level you're going to want to watch from that perspective. Also, you're seeing big movements in the pound. You can see yesterday the pound was up pretty sharply. We gave all those gains back. We're now trading back to the lower end of the range. Again, what's important here to take note of is that, again, you're at the lower Bollinger Band around 128.75. The other thing notice is that you touched this low here around 128.45. Here was your low here on the 31st, 128.43. So you're touching and testing the lows that you saw at the end of October. Clearly, a break of this level here around 128.45 is going to open the door to much lower levels to come, potentially back to this 126.90 region. And a lot of that can be determined by where, how the Fed sort of positions itself coming out of its meeting on Thursday, which would be preceded by the BOE statement on Thursday morning. In the meantime, gold you're seeing is actually pulling back some, and this is going to be the effect of higher rates, a stronger dollar index. The dollar index is up 1.5%. And so gold is obviously going to probably struggle in an environment where interest rates are moving significantly higher and where you're seeing the dollar strengthening. If you notice on gold, you can kind of make a case that maybe there's a head and shoulders pattern forming in here. Again, if you break this level here at 27.20, it could open the doorway to seeing lower levels, potentially down to 26.05. Again, when we just look at it from a Bollinger Band perspective, here's your 20-day moving average. This is also going to be an important level of support. If you really start losing this 27.20 region, I would start looking for levels closer to 26.30. Again, I think you got to be very mindful where interest rates are, especially on the longer end of the curve, 10-year, 30-year rates, and the dollar index is going to play a lot into this because, again, you're seeing very, very big swings in currency markets. The euro obviously down by 1.8%, following what had looked like a pretty good recovery. So again, trading at the lower end of its Bollinger Band, support somewhere around 106.70 from that perspective. A break of that opens the door to much lower levels. Anyway, I think given the events here, I think rates and the dollar continue to be the most overriding factor in this, because I think those are ultimately going to drive where equities go, and that's going to obviously play into where currency. That's obviously going to also play into where commodity prices go as well. Anyway, hope you have a great day, and we'll see you next week. Bye.